Welcome one and all to another episode of our weekly market update provided by SE Securities. As always, we will be going over the happenings of the stock market for the week, as well as touching up on some of the macroeconomic news, the secondary or the bond market news pertaining to the week, before we dive into global commodity prices, as well as the global markets roundup. As always, that will be followed up by Harin, who will give us the technical analysis on our commodity counter this week, as well as notions on the all share and our pick of the week for this week. So without further ado, let's dive in. This week, we actually saw somewhat of a consolidation story in the market. So Monday, actually, the market turned red. But before that, let me just give you some of the major headlines. The all share actually rose by 1.94% this week, whilst the S&P rose by 2.48% for this week. So if we now just break it down from a daily perspective, on Tuesday, the market actually started out in the red, and it meant that the Colombo bourse actually witnessed a third consecutive day of losses, following from the negative figures on Thursday and Friday last week. However, we saw towards the end of the week, this being somewhat leveled off, and by Friday, actually, the index ending up in the green zone well and truly. So on Monday, we saw the retracement mainly driven by index-heavy counters such as Expo, LOLC, and Bill. Wednesday, we saw some of the recovery mainly driven by JKH and Expo, whilst Thursday also was driven by index-heavy counters such as JKH, Melster Corp, and Expo. Friday also, we saw a large gain. Actually, we saw the index pick up by 109 points, again on the back of index-heavy counters. But however, we need to state that this week we saw some of the lowest turnover figures. So actually on Tuesday, we saw what was a 2.5-month low in terms of turnover. Right here, it's 1.7 billion. And over the week, turnover actually averaged roughly 2.3 billion, which is quite low compared to prior week's performances. So even then, even though the bourse actually ended up in the green zone, we didn't see huge upticks because of the low turnover numbers. In terms of the foreign outflow situation, it seems to be the one consistent thing in the Sri Lankan market. Foreign net outflows for the week came in at 159 million. So now with all of that in mind, what we do have to say is the market at this point, it has consolidated and is coming out of a consolidation phase. Initially, we did predict that the market could actually retrace much further than it did, but it has consolidated at the 8,700 levels. We may see the bourse actually touch the 9,100 level, where we may see another retracement possibly, but I think Harin will be able to lend some deeper credence into that. So that is what were the main highlights of the stock market for this week. Moving on to the economic news, a momentary solace, inflation falls. So the headline inflation rate actually fell by a marginal amount of 0.1% to 6.7% for August when compared to 6.8% in July. And that small decline was actually attributable to a fall in the non-food inflation segment, or the non-food segment. We saw food inflation actually up to 11.1% when compared to 11% in July, in the month prior to that. But despite the fall, it still the inflation rate still very much remains above the central bank's target threshold. And one major reason for the slight retracement in inflation can be attributable to the fact that in early August, we saw a policy rate revision or a policy rate uptick. So that might have had some impact or bearing on the non-food segment. Looking forward, we do expect food inflation to rise due to a shortage in chemical fertilizers, which will put an upward pressure on prices as there will be a shortfall in output. However, this could potentially be offset by a reduction in the non-food inflation segment, And that is potentially on the back of further policy upticks down the line. So the next monetary policy review board is scheduled for the 14th of October. And what we're predicting is that there will be another imminent policy rate revision upwards. So that might offset any huge increases in the food inflation. But I think, or we think in this matter, that food inflation figures might actually rise in September, may rise going forward. And in terms of other news, we saw that earlier this week that Sri Lanka finally made it off the red list for travel restrictions from the UK, which is very much a welcome news, as the UK represents the third largest market in terms of inbound tourism. Well, the Sri Lankan Airlines have, as well as the Tourism Development Board, have touted that they're hoping to hit $500 million US dollars in amounts of earnings this winter season, upcoming winter season. This, of course, would be somewhat of a welcome boost to an industry that has been bereft of any earnings since the onset of the pandemic. Tourism actually was the worst hit sector, if you really think about it. With the current rapid vaccination program ongoing, hopefully the country will be able to lift restrictions sooner than expected, which also would signal to other countries around the world to maybe remove or potentially remove Sri Lanka from the red list, thus increasing the potential for inbound tourism. However, that optimism must be kept in check, because whilst these initiatives are pragmatic, we must also take into account the fact that global disposable incomes have taken a significant hit. And whilst tourism, along with worker remittances, is seen as Sri Lanka's two main salvations at getting forex earnings into the country, it might take a bit longer for us to see anywhere near the levels that we're accustomed to seeing from the tourism segment. In terms of the secondary market, all eyes were actually on the auction that took place on Wednesday, because this was the first auction where we didn't see the yield controls in place since March 2020. But we did, and one specific outcome from that was Sri Lankan Treasury yields rose across the board. So the 12-month yield went up by 38 basis points to 6.5%. The 3-month yield actually rose by 30 basis points to end up at 6.38%, whilst the 6-month yield rose by 32 basis points to 6.27%. Overall, the auction wasn't a success in the sense that only 48% of the auction was sold or bids accepted. What this does tell us, though, that is that whilst yields are continuing to rise like this, or set to rise like this, this also is another signal that there may need to be another policy rate revision, or in this case, policy rate uptick in the near future. In terms of the global commodity markets, we saw oil actually rise significantly on Thursday, with the price of Brent oil actually hitting a 2-month high, driven primarily on the back of increased global fuel demand, coupled with the continued lag in US crude oil inventories, as production still continues to be somewhat sluggish in the Gulf of Mexico after the backdrop of the 2 hurricanes that occurred there. Gold is actually an interesting counter, and this is our commodity watch for this week. So we saw a weekly reduction in the counter, so a 5.6% fall, and settling somewhere around $1,755 US per ton, per troy ounce, I beg your pardon. Now, we all know that gold is a traditional safe haven from any potential crashes in fiat currency. And what we expect is gold to actually rise in 2022, or we are hoping, or we are predicting that gold prices will rise in 2022, with the fact that there is still very much global uncertainty plaguing the market, with the whole economic recovery going as much slower than expected by experts, as well as fresh developments such as the new Basel III regulations that came into effect. which had a slight impact at minimizing the amount of paper gold trading by banks that did not hold physical metals to cover their liabilities, as well as now this week, we will touch upon it in our global market segment, the fears that were stoked due to the Evergrande group in China. So a combination of these factors, coupled with the fact that there is still very much an uncertain outlook in terms of the global economic recovery effort, we might actually see gold rise up during the start of the next year. In a best case scenario. However, we do need to stress that we do feel that this current downtrend in gold will continue in the short run. And aluminium prices, surprise, surprise, continues to rise this week, hovering at a 13-year high. As we have mentioned before, on numerous occasions, this is due to the country's or China's stance to attain carbon neutrality in 2060. Production in China has actually been hampered further by tight electricity supplies as the country has been hit by a drought as well as a surge in thermal coal prices. So that has actually taken quite a huge hit on aluminium production in China. And as we move on to global markets, so the main headline here is, as everyone is aware, earlier on this week, we saw the news pertaining to Evergrande. And Asian markets very much ended up in the mixed region, and it followed what was a rough week for Asian and global markets, especially during the start of the week, as China's largest real estate company, Evergrande, were potentially on the brink of defaulting due to their inability at that time to repay their debts amounting to close to $300 billion US, which is roughly 2% of China's overall GDP. So the Hang Seng actually closed 0.27% down for the week, whilst the Nikkei was down by 2% for the week. The Shanghai SC Composite, however, was up 1.14% on Friday. However, for much of the week, these indexes were plagued with the investor trepidation over Evergrande. And this actually spilled to European and US markets. So there was a cautionary stance in European markets. Even though they did slip slightly on Thursday, they were able to actually hold their gains for the week. So the Pan-European Stock 600 closed at 0.9% up on Thursday, with most of the major bourses in the positive territory. However, we saw the FTSE down by 0.1%, and that is due to the fact that the Bank of England have kept policy rates as is to combat the rising inflation. So usually the Bank of England has a target inflationary threshold of 2% with a 1% deviation either way. But what forecasts are saying is inflation could actually hit 4%. So the Bank of England right now has been keeping its policy rates as is. And furthermore, another reason for the FTSE to fall has been there was a downgrading in projections for economic growth in the third quarter. US stocks, much like the European and Asian stocks at the start of the week, did actually falter on the knock-on effects from Evergrande. However, they did rally midweek by 1.48%. As fears of the Evergrande crisis eased on US shores, coupled with the fact that the Fed actually signaled they will keep the current level of monetary stimulus for a little while longer than expected previously. Those are the main headlines for this week. As always, I will now hand it over to Harin, who will take you over our commodity watch this week, which is gold, followed by the notions on the ASPI, and finally taking you over our pick of the week this week, JKH. Over to you, Harin.
Thank you, Nuwan. So as we speak, looking at gold from the daily chart, we can currently see that the RSI is at 36.83, which is quite in the mid-range. And gold is quite struggling at the daily support level, which is $1,740, $1,760. And we were able to see how during the past few days and weeks, we were able to see how gold has been declining, making certain lower lows, lower highs, lower lows, lower highs. So at the moment, gold is at a daily support level of 1,740, 1,760. So if the price manages to sustain at this level, we'll be able to expect gold coming up again and testing the 1,800 key region again. However, if the gold price actually fails to sustain at the daily support level of 1740, 1760, we'll be able to expect it more coming down to the level of 1700. So we can clearly see that how gold has been declining since June, and how it has been actually in a downward trend, and we had a somewhat around a breakout, breaking the declining trend on in September first week. However, this has been actually a false breakout where the price actually managed to again decline, further decline to the daily support level of 1740, 1760. So it needs to actually sustain above this level of 1740, 1760 in order to push the price again to 1800, or else we'll be able to expect it actually coming down to the 1700 key region, which is actually another psychological area of gold. So looking at the all share index from the daily chart, we can clearly see that how that there was a decline, how it was actually, how the resistance of 9000, 9050 was actually a key psychological area for the index. And now we were able to see the index getting somewhat around reverse from 8725.42 after making a low on 21st of September. So after making that low, we were able to see how the index managing it to go to pull back to the daily resistance of 9000, 9050, and we do have inverted hammer over here, which signals us bullish reversal pattern, whereas the index moving to the daily resistance of 9000, 9050. So looking at a minor time frame like 4 hours, so we can clearly see we do have a left shoulder over here, we do have a head over here, and also we have a right shoulder over here. So if this is an inverted head and shoulders pattern, so this could be the probably the neckline could be around 9000, 9050. So that would be the key neckline for an inverted head and shoulders pattern. And also in the daily chart, we can clearly see that RSI is still in the mid range, which is 56.79. So in the daily chart, we can clearly see the in the forward chart, we can clearly see the RSI is at around 56.56, and also actually the price moving, the index moving, pardon me, the index moving to the daily resistance of 9000, 9050 again. So we had a declining trend over here where we had certain lows, and we had a breakout today, and we were able to see the index closing at 8956.55. And also now we do have we can clearly see that the bulls are actually pulling the index, pushing the index to the key area of daily resistance 9000, 9050. So if the index manages to break 9000, 9050, we'll be able to expect the next key resistance 9250, 9300. Else rejection from 9000, 9050, which is the psychological area, will be able to expect coming down again to the 8725.42, which we had a reversal there. So that would be basically 21st September low. So looking at John Keels, this is the monthly chart. So the reason I have taken the monthly chart is just to see that how the price has been actually consolidating over the past few years and months. So the monthly RSI comes to around the level of 46.44, and also the price is actually trading at a monthly support level of 130, 135, where the price actually closed for the week at 135 rupees per share. So we have a weekly resistances at 155, 157. So looking at the previous structures, looking at the previous consolidation period, if the price actually sustains at the level of 130, 135, and enough volumes pulls in to the market for JKH, will be able to expect it actually reaching the weaker resistance of 155, 157 again. So whenever the price comes to a level of 130, we can clearly see even during the past few months how the price actually getting rejected from that key area over and over again. So that means actually 130 and 135 is a strong level of support for JKH. So worst case scenario, if the price manages to break that key level of 130, 135, we'll be able to expect it the weekly support 112, 115. That would be very that won't be actually happening anytime soon, because whenever we look at the chart, there is so much consolidating happening during the past few years. We can see clearly, even when the price actually comes down below the 130, even that is considered as a false breakout, like in 2016 and like in 2018. We can clearly see when the price actually tries to push below the monthly support of 130, 135, it actually bounces back up again to the weekly resistance of 150, 557. So the initial key level would be, the next key level would be the weak resistance 155, 157, and further, if that key area manages to break, we'll be able to expect the monthly resistance of 175, 180. But first, we would be able to see how in the coming months how this support level actually has a strong has considered as a strong key area, and we can clearly see how the couple of rejections has happened in the previous few months and years. So therefore, the key level would be with the weaker resistance 155, 157, if the price actually sustains above the key level of 130, 135. So thank you. Over to you, Nuwan.
Thank you, Harin. And as always, everyone can catch this report as we do share it with our client mail. And we will now, from this week onwards, be uploading it to our LinkedIn as well. So please do give us a follow on LinkedIn, and you can see our weekly updates as well on there. And please do give us a like, follow, and subscribe to us on our various social media platforms. We do inundate these with all the latest information to keep everyone updated and provide them with the best quality investment research pertaining to capital markets. So as always, thank you for joining us, and we look forward to having you again next week. Till then, take care.